Dad, have you ever heard before? Like, this is a classic example. The Great Wall of China is the only man-made object visible from space. Have you ever heard that
Not
before?
true. I've heard it. It's not true.
Exactly. That's
That's a
something,
perfect analogy. Perfect
I've heard it
analogy.
so many times throughout my life, and only recently did I find out that that's actually not the case. And it's a classic example of something you hear so often that it's true, but it's not.
You're listening to Retirement Straight Talk with Paul and William, a father and son team helping you tackle financial planning challenges and real world decisions that matter most. Each episode, we'll share straightforward advice and proven strategies to help you build your dream retirement.
Welcome back, everyone, to another episode of Retirement Straight Talk. I'm William Barreca, financial planner at West End Wealth Planning, and I'm joined by my co-host and dad, Paul Barreca.
Hello, everyone. Glad you could join us again.
Yeah, we got a fun episode today. I think everyone out there, most people nowadays, you spend time on YouTube, Instagram, or watching the financial news, and based on that, there's no shortage of opinions about investing, or maybe there's that opinionated friend, family member, or colleague.
Oh,
And
yeah. Oh, yeah.
the problem, Dad, is, and you know this quite well, is that a lot of what gets repeated about investing, it's not actually backed up by any evidence. And it's not most of the time, it's not because of these people are trying to be misleading or anything like that. It's just because simple, catchy ideas, they tend to spread faster than just boring, nuanced truths. And these misconceptions, they don't become facts because they are tested and proven, but because they're repeated, easy to remember, and they just kind of feel right. Dad, have you ever heard before? Like, this is a classic example. The Great Wall of China is the only man-made object visible from space. Have you ever heard that
Not
before?
true. I've heard it. It's not true.
Exactly. That's
That's a
something,
perfect analogy. Perfect
I've heard it
analogy.
so many times throughout my life, and only recently did I find out that that's actually not the case. And it's a classic example of something you hear so often that it's true, but it's not. And so some myths like that are mostly harmless, but in investing, bad myths can be incredibly damaging to your financial health.
Well, I was just going to bring up a bad example. Second World War, German propaganda, Joseph Goebbels, that was his way of thinking. You say a lie enough and it becomes the truth. And you see that everywhere. So, yeah, perfect.
So, in our last episode, we used data from investment research firm YCharts to break down 6 common investing myths. And today it's part 2 of that series. We're going to walk through 7 more myths, and we're going to pair the story you often hear to what the research and real world data actually says. And by the end of this episode, you'll know which common investment myths to ignore and how to make more confident, evidence based decisions with your own investments.
Yeah, this is where we kind of shift from why people hesitate to invest to how people get tripped up once they're already in an investment. And it's a very important conversation because we see this mistake happening all the time. But before we kind of jump into that, if you're looking at your portfolio and planning for your retirement, or even just thinking about it, make sure that you download our complimentary white paper, How to Build Your Dream Retirement and Avoid 7 Common Mistakes that can completely derail it. And this really focuses on a lot of the things that we're talking about today. Again, you can have a great plan, spend all the time on it, it's perfect. But if you fall for these very common mistakes, it doesn't matter. It's all going to fall to pieces. So the report defines step by step how to define your retirement goals, a plan that fits your life, and how to stick to it. And you can find the link in the show notes. You can download that and absolutely free. And free is pretty darn good the way I see it.
Thanks, Paul. Okay, let's get into it. Myth number 7. So again, remember, if you missed part 1, go back and watch it. But we're on myth 7 now, which is fallen stocks will always bounce back. Um, and this is one that really gets people into trouble. They hold on to a stock and then it plummets, and then they keep holding on to it, expecting it to rebound just because you think it will.
Well, this relates to also not just stocks, it involves to real estate, whatever. How many times have we heard someone say, "I'm not selling this investment, unless I it goes back to what I paid for it," or "I'm not selling this house unless it goes up to this dollar value." But the market doesn't care what you think. The the way to make that decision is you always must say, "As compared to what?" Perfect example, if you're looking at a stock, let's say you bought a stock for $100, it's worth $70 today. You say, "Well, I wanna wait till it goes to 100." That's the absolutely perfect way not to make money. What you should look at is say, "Okay, what if I had $70 today? Where would I put that money? Would I buy that same stock or that ETF or mutual fund or whatever?" Probably the answer is no. That's when you should sell that stock or mutual fund or ETF. No,
Yeah.
well, we got some examples of stocks, just individual stocks,
Oh,
Enron, Sears, there's
history's
it
loaded with some dad. Enron, Sears, BlackBerry, to use a good Canadian example. Um, Not a good one, but fitting here.
hey, well, I just gotta interrupt there because I gotta tell everyone, when BlackBerry was doing well, William my son William, who's here, uh, everyone had BlackBerries back then, so I bought William 1 BlackBerry share, which he still has. I don't think it's gonna make you rich. It's in your portfolio, 1 share.
I forgot about that. I've owned it now probably nearly 15 years, and, I still own it just because the cost to sell it is more than
It's
what the
not worth
share
it.
is actually worth, so that's a perfect example. I've been waiting, like I said, nearly 15 years for it to bounce back, and it
Hope
it
you have a
doesn't
long
always.
life.
Well, me too. Doesn't always happen. And, where I think a couple ways people get tripped up here with this dad is exactly what you said. They hope that it's gonna recover, or they say, after it plummets, I paid $100 for it, so I'm not gonna sell till it gets back to it. Like you said, whatever happened in the past, that's old news. The only thing that matters is what's gonna happen in the future. And I mean, um, this is a big reason too, Dad, why we prefer more diversified investments in our practice versus picking individual stocks, because the research tells us that investments like that will do better, and it's also just easier from an emotional side, I find too, and people get emotionally attached to these stocks. And it gets really hard to sell, both when they're going up because you think it's going to happen, it's going to keep going up forever, and then on the way down too, you hope for it to get back to the previous, to whatever you
Yeah.
paid for it.
By the way, one of the worst examples of that is if you, work for a company and they're giving you some type of stock plan. People tend to fall in love with that stock. They don't wanna sell it. I remember one of our older clients said, they had a very significant portion in one stock. I'm not gonna mention the name. He worked there, and he says, "No, the company's told me. They've told us they're great plans. This stock is really gonna do well." He had more than half of all his portfolio in one stock. You fall in love with a stock, especially when you work for the company. So, not good, not good.
Myth number 8, Dad. The more mutual funds or ETFs in your portfolio, the better diversified you are.
Boy, yeah, we've heard this lots of times. People will come into the office and they'll say things. We'll look at the portfolio, and there's only 6 or 7 different mutual funds, ETFs, doesn't matter. And we go, "You're not very diversified." And they'll say things like, "What do you mean? Look at I got all these funds." But they're all essentially similar. And what that they own similar holdings, not exactly the same things, but similar. So what that means is you don't know. Oftentimes you're well over concentrated in certain industries, sectors, geographic reasons. People don't realize that what you're actually doing there is often significantly increasing your risk without the diversification. So you'll tend to have a lot more volatility. Having more investments isn't needed. You can have a completely diversified portfolio in one position, one ETF or one mutual fund that owns virtually all of the market.
The key is you gotta look under the hood of what you actually own, the number of positions you hold. it's almost meaningless in terms of telling you how diversified you are. Exactly what you said. You can own one mutual fund or ETF that's way more diversified than another portfolio of 10 to 20 holdings. That if you look under the hood of them, are all just variations of mostly the same thing.
Yeah, you want to look for a balance between asset classes, sectors, geographic areas, and avoid the overlap because the overlap provides additional risk that you're probably not aware of.
Yeah.
So,
And just before we move on, a very classic example that I'm seeing online a lot now, Dad, that's indicative of this is I see a lot of investing people online. They'll say, okay, here's the perfect portfolio you need to own right
oh,
now.
oh, really? The perfect
It's,
portfolio.
yes, they say you need an S&P 500 ETF and a NASDAQ index ETF. And that's a classic example of where if you look under the hood of both of those investments, they own mostly the same things. The S&P 500 is comprised mostly right now of the big technology companies that are
Yeah.
also in the NASDAQ. So you have two different investments, but you own mostly the same things if you look under the hood of it. So I just
Yeah,
wanted to
isn't
bring that up because I see it online a lot nowadays.
I think the big 7 companies, Microsoft and Apple, I think they're 35% of the S&P right now, something like that.
Around
So,
there,
like
yeah.
a good third, roughly a third.
Okay. Let's move on here. Myth number 9. Successful investors take big risks.
Oh, I like this one. I'm gonna have some fun with this one. Can I start? Can I ta we talked yesterday what I wanna talk about. I wanna talk about tennis. You say, "What does he want to talk about tennis for? We're talking about investing." I wanna talk about Roger Federer, probably one of the best tennis players of all time. In his career, Roger Federer played I got my note I wanna make sure I got my numbers right, 1,526 singles matches, over 1,500 singles matches, and he won, I think, 20 grand slams. And again, I'm not a big tennis buff, so I'm not sure what that is. But anyway, he won a heck of a lot of tournaments. Now, he won over 80% of all of his matches, or just under 80%. What percent of his volleys do you think he won? Remember, he won just under 80% of all his matches. What percentage of volleys? Now, I bet a lot of people out there are saying, well, I don't know, he probably won 75, 80% of his volleys. He won just 54% of his volleys. 54%. That's the best you can do? And the reason he does it, I apologize, I'm going over here. In many respects, this relates to investing. He knew he didn't have to win every volley. He knew he didn't have to be the most aggressive. He knew he didn't have to go for winners all the time. He positioned himself intelligently. Try to minimize errors. That's the key one. Underline that, capitalize it, minimize errors, avoid risky situations. By playing smart rather than reckless, he ensures that stays control of the match. And that's so similar to investing. I mean, all these guys, Buffett, of course, they say stay out of trouble, stay out of trouble, stay out of trouble. That's what Federer did. Same thing Buffett would say, stay out of trouble. Don't go for that fancy new investment, that usually high priced, overcomplicated investment that oftentimes doesn't work out because you want to get rich quick. You want to avoid those. I've heard heard you probably heard this too, Will. One of the best ways, or a lot of people want to get rich quick. One of the best ways to get rich quick is slowly. And that's the key.
That's it, Dad. Everyone, it's not just in investing, but in everything else in life, everyone wants a shortcut, don't they? Everyone would love,
Yeah.
that get rich quick
Good
scheme.
analogy.
Um, and like you said, getting rich in investing, it's actually pretty simple. You just use a low cost, diversified investment, have a high savings rate, and control your behaviors during your investing career. And simple, not always easy, but it's incredibly simple to do. It just takes time, and a lot of people don't have that patience. A thing I liken it to a lot is losing weight, right? Like we all know,
Mhm.
again, losing weight and staying in shape, it's actually
Oh, geez.
it's pretty simple. You just eat well, you choose an exercise and do it consistently, And that's mostly all there is to it. But yet everyone wants it to happen overnight. That's why there's all these pills out there, these fad diets, fad exercises.
Lose weight quick. Just eat grapefruit juice for the rest of your life and you'll slim right down. You know, if you think about it, markets go up about 2/3 of the time. 2/3 of the time. Federer won 54% of his volleys, and he was one of the most maybe successful tennis players ever. Think about that. It's just as you mentioned, Will, master your behavior. Understand that markets go up 2/3 of the time, because that means they're gonna go down 1/3 of the time. When they go down, probably the best thing to do is nothing. Probably the best thing to do is nothing.
Okay, let's move on here.
What's the next one here? What are we doing next? Number 10. Oh, boy.
So,
This is fun too.
I'm glad you're having fun. Myth number 10, percentage gains and losses are equivalent. And this one, it seems simple, but it can really distort investor expectations. So it's the idea that a percentage loss and an equal percentage gain cancel each other out.
Yeah, and this is something, by the way, I think, I've been in this business 35 years. I think people are getting more attuned to these things. But here's a simple example. If you have $100,000 and you lose 50%, now you have $50,000. You had 100,000, now you have 50. You lost 50%. Well, what percentage return do you need on your 50,000 to get up to 100,000? You need 100%.
The deeper the
This is
loss, the steeper the climb, isn't it?
And this is where leverage can get people into trouble if they don't use it properly, but we're not here to talk about leverage, that's for another day. Absolutely, so that's where when people try that get rich quick scheme, uh, buy that investment that's too risky or too speculative, that's where you can get into trouble here. You gotta look at the downside protection through things like diversification, rebalancing, staying focused. In other words, doing all the boring, easy, simple stuff that is proven to work rather than trying something fancy, and the math just proves it.
Okay, well put. All right, now myth 11. This is actually very timely this year. Gold is a safe haven. Um, I feel like so this has been talked a lot on the news this year because gold's actually had an incredible run this year. So it's really talked about on social media a lot right now too. And it's the idea that gold is just a reliable safe haven investment.
Yeah. I can share with you a little story that I hadn't talked about before. I'm in Florida, and I went in last year to get my shoes fixed, the sole, doesn't matter. And the shoe repair guy, while I'm talking to him, he's on his phone checking the price of gold. He has money in gold. Oh, and he said, "Look, gold went up this morning by whatever it was, it doesn't matter." And I'm looking at him going, "Oh my gosh." And over the last year, that's worked out very well, but over the long term, as you mentioned, well, you have some statistics here that I bet
Well, the
people will be surprised about.
The data shows that gold, it hasn't been the consistent winner people think it is. There's stretches and there's been in several decades where it significantly underperformed stocks,
Yeah, by a
even
lot.
adjusted for inflation. So, for instance, over the last 15 years, gold has returned 6.3% annually, and compare that to just the S&P 500 in the States, which is nearly 15% over that same time period, with basically the same amount of volatility if you look at it. So you're taking on almost the same amount of risk, but getting less than half of the return. And Dad, let's go back even further. Um, gold did great in the 70s.
Yeah.
And then in the 80s, it started to decline steeply and into the 90s as well. So in the 70s, went up, it shot up a lot. In the 80s, started to go down. Gold on an inflation adjusted basis didn't pass the high from the early 1980s until last year, 2024. So can you imagine that? That's over 40 years waiting for gold to recover from its past. So I'd have a hard time investing in something that over 4 decades, doesn't even, do that.
Generate any income, no dividends, no like by the way, you know what? gold in the next year could continue to skyrocket or it could go in the toilet. We don't know. That's the nature of it. I would look at gold as almost more of a speculative type investment. It's like I'm putting all my money in oil. I think the price of oil is going to go up, or platinum or whatever. That is really not investing. That
Well,
is more like speculating the way I look
that's
at it.
exactly it, Dad. Like, I mean, you touch on it there briefly. Gold, it doesn't produce anything. It's just a piece of metal that sits there. Whereas if you invest in a stock, it's just partial ownership in a business. So that business, produces
Something
goods,
tangible.
provides services, makes money, and you have partial ownership of that. Whereas gold, you nailed it. It's just speculative because you're just relying upon on the next person to be willing to pay a higher price for it than you did. That's all it
Yeah,
is, really.
same as crypto, right?
Yep.
Buffett said, again, well, quote Buffett because he's so smart. He says, "If you offered me all the crypto in the world for 25 bucks, I wouldn't give it to you because it's nothing. It depends. It's worth nothing. It's valueless. It accomplishes nothing. The only way you can make money is if someone else will pay more for it. At least gold's had a little bit of use. It's used in jewelry and that, but similar to crypto.
Okay.
All right,
Let's.
next myth. Where are we going next here? Ah, this is
All right.
one we've had fun talking back and forth about.
So myth number 12. A high dividend yield means a safe investment. And this is another one where, similar to gold, investors often get misled.
Well, yeah, I mean, there's been people who say buy good dividend paying companies. They produce a better return than the market as a whole. And actually, there's been period when that's been very true. The last 5 or 6 years, it's not been true. For example, if you own the banks and dividend producers of the last 5, 6, 7 years, they've done a significantly provide a significantly lower return than just buying the market as a whole. Um, Now we're talking about high yields. So a high yield can be a red flag. Wasn't BCE a few years ago? There's BCE. People figure there's a great
Hell.
stock that it created a very high dividend because they were in some short-term financial trouble, and sure enough, the dividend got cut. The stock took a haircut. Oftentimes, a high dividend yield means that there's some problem behind it. They have to pay out that high dividend uh, to attract people, and that usually means there's a problem somewhere. So that's something you really want to be aware of.
So yeah, I mean, Dad, this is where people or investors get tripped up so often. And again, they misconstrue it as a high dividend company is safe. Maybe it's a retired client who says that, I need the income. I'm retired. I want to be more conservative, so I'm going to buy dividend stocks, or even just a person that's still in their working years who says, I want to take a more conservative stance in my portfolio, so I'm just going to buy these dividend stocks. And the problem with that is that the dividend only tells part of the story of your return. And YCharts had some really great stories of companies that paid really high dividend yields, but their performance was negative even including the dividends. So you can look at they had Brandywine Realty Trust with a dividend yield of nearly 15% and
Wow.
but Dad, on a
Didn't
10-year
do too
total
well, eh?
return, negative 32%. Again, that
Yeah.
includes the dividend. Just there's a whole host of examples here, but one more, Nordic American Tanker. So again, paid nearly 15% dividend on a 10-year basis, negative 62%. So if you're out there, just realize a dividend only tells part of the story. The fact that a company pays a dividend does not necessarily make it a conservative or safe investment. In fact, it can actually mean it's actually the exact opposite and not a safe investment.
Yeah. Just quickly too, you were talking about income. A lot of people want income, and no doubt about it, dividends provide income if you're retired and so forth. If you're not retired and you don't need the money, getting a dividend just means you're paying tax. I'm talking about non-registered money, and I don't see any purpose in that in paying tax early. And even if you're retired and you need income, remember a dividend is just a company paying out part of its cash. rather than reinvesting it. Well, you could do the same thing. Just take if you have an ETF or a stock, just have a systematic withdrawal and take some capital gains. You may pay way less tax on that because you'll take some original capital. Matter of fact, you will almost certainly pay less tax just selling a few shares every month rather than taking a dividend, and the company may produce a much better and longer return. All right, let's go. Let's go on to the next myth here, which
Myth
is
myth
number
number 13.
13, right?
You got it. Number 13. So it's bonds are risk-free investments. And I know, Dad, we touched on this in part one, but you want to expand on it a little more too, is GICs as well also aren't risk-free investments. But let's start with the bond aspect of it. Um, we've seen this unravel in real time. Bonds have risk. They've interest rate risk, credit risk, inflation risk, and they may not always be as volatile as stocks, but that doesn't make them risk free.
Well, yeah, I mean, recently in 2022, when interest rates were going through a significant increase, or when inflation was increasing, the value of a bond, the aggregate bond index, lost, I think, 14% in 2022. It had never lost that much, almost the same amount as stocks, because as interest rates go up, the value of those bonds go down. And you're right, Will. And people need to understand there's also very different types of bonds. Now, I just want to touch on GICs for a minute. GICs a little bit different. The values don't drop, but if you want to look at what risk is, and if you want to maintain the value of your capital, if you buy a GIC today for 3% and you're paying 1.5 of that in taxes, and inflation is 3% or 2.5%, you're losing money every year in purchasing power. Every s- Guaranteed to lose money. To me, that's not, unless it's short-term money. Of course, you should never invest short-term money anyway. Not a good idea to put that money in something short-term like that.
Yeah, I mean, certainly if you look over long-term time periods, I mean, the iShares the Core US Aggregate Bond ETF, which is just a broad proxy for the bond market, had a 2.2% annualized return over 15 years. Um, and that came with some volatility as well. So I wouldn't call that zero risk. And that return, it pales in comparison to equities or stocks over that same period. So I think people have to realize it's a reminder. Every investment comes with a trade-off, and the key is understanding what kind of risk you're taking on and how it fits into your plan. So all this isn't to say that bonds or GICs don't have a place. Like bonds can provide some stability, diversification, but they're not immune from volatility, and they're not just a silver bullet in your portfolio either.
Yeah. Okay. Hey, probably a good time to wrap things up today. I think we got all our myths that we want to chat about.
That's correct. So that's a wrap on part two of our series on investing myths. So this half of the conversation really speaks to people I think who are already investing and want to avoid some common blind spots.
Yeah. So we'll leave it with a few of the biggest insights we covered today. First thing, a small in stock or ETF or mutual fund doesn't guarantee a comeback. Secondly, diversification isn't just about owning more ETFs or mutual funds or stocks, it's about reducing concentration and overlap. Next thing, big risks don't always equal big returns and big rewards. Matter of fact, I suggest big risks oftentimes don't equal big rewards, they equal big losses. Next thing, a 50% gain doesn't cancel out a 50% loss. You need a 100% gain to cancel out a 50% loss. And again, that goes back also to risk. Gold and dividends aren't always safe, the safety nets they're marketed to be. And even bonds have a risk. You really want to consider the interest rate environment, taxes, and so forth, certainly before you look at bonds as part of your portfolio. And before we wrap it up, remember, a lot of what we talked about today is something that's in our complimentary guide, our white paper that you can download at no cost, called How to Build Your Dream Retirement and Avoid the 7 Mistakes that could completely derail it. Step by step, It talks about how to identify what matters most and avoid those missteps in your plan that, boy, they can wipe out a decade of gains just by making the wrong decision on something important. So go download that now. It's in the show notes below.
Okay, well, thanks everyone for watching and listening. If you found this helpful, be sure to like, follow, and subscribe to us on YouTube, Apple, Spotify, or wherever it is you get your podcasts. And we'd also appreciate if you could leave us a review on those platforms as well. It just helps others find the show and join in on the conversation. So, thanks again for joining us, and we'll see you in 2 weeks for the next episode of Retirement Straight Talk.
The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.